Hi, everyone. Thank you for tuning in to our panel on net zero transition, investor expectations and reality for companies. My name is Lyndon Park, and I'm the head of ICR Governance Solutions, where we advise clients on ESG and shareholder advisory matters, from creating ESG disclosures and strategy to advising on proxy contests and other contentious event-driven situations. Formerly, I led the stewardship team at Dimensional Fund Advisors, and previously was one of the sector leads at BlackRock Stewardship, where I was and still am my mentor, Michelle Atkins' favorite protege, right, Michelle? Just nod. Fittingly, this week is Climate Week in New York City, and today's topic, especially in these times, seems to have even existential consequences. According to the International Energy Agency, or IEA, the path to net zero emissions is possible but narrow and requires immediate and massive deployment of all available clean and efficient energy tech. Now, IEA calls for nothing less than a complete transformation of how we produce, transport, consume energy, but also acknowledges that net zero by 2050 is difficult without behavioral change by consumers and without low emission tech usage and end uses. Today's panel really is about what devils are in these details. If the path to 2050 net zero is narrow and treacherous, it also likely means it demands our special focus on the nuances, the potential unintended consequences, and concerted effort from the regulators, investors, and companies on how we can practically solve for the net zero future. Joining me today are illustrious panelists, Ben Dell from Cambridge Energy, Michelle from BlackRock, Karen Mangone from Goldman Sachs, and Sebastian Niles from Markel. And rather than bungling anyone's introductions, which I often do, I'd like to ask the panelists to briefly introduce themselves. And we'll start with Ben.
Hi, Lyndon. Thanks for the opportunity to be here. My name is Ben Dell. I'm the founder and managing partner at Cambridge Energy, private equity focused on upstream oil and gas, but also increasingly involved in the carbon markets.
Michelle?
Hi, everybody. I'm Michelle Atkins. I'm a member of the investment stewardship team at BlackRock, and we're the team that has the discussions with the public companies that we invest in on behalf of our clients about their corporate governance and about their business practices, so that we can understand that the companies we're investing in for our clients have a long-term viable business model that will generate the financial returns that our clients are depending on to meet their savings goals.
Karen?
Thanks, Lyndon. It's really great to be here and excited to have this conversation. I lead climate strategy at Goldman Sachs, so it looks at everything from how we deliver on our carbon neutrality and net zero ambitions to how we report out our progress to the world and engage with stakeholders, to how we put this at the forefront of our work with clients.
Thank you. And finally, Sebastian.
Yeah, hi, delighted to be here today. Sebastian Niles, I'm a partner at Wachtell Lipton, Rosen & Katz. In addition to M&A and takeover defense matters, I lead our shareholder activism and engagement work, as well as corporate governance and ESG related task force initiatives.
Great. Well, thank you. And, today's conversation, I've shared with the panelists, it's meant to be very open and fluid dialogue. As I mentioned, there are a lot of nuances to tease out, as well as I'm sure audience members have questions, which we will address the last 15 minutes of the discussion. I'm going to put Michelle on the spotlight first, because, she's my mentor. Obviously, Michelle, BlackRock's position when we were reading your position papers are remarkably consistent with IEA's findings, and it signals a really rapid capital reallocation in the marketplace. Now, BlackRock has clarified for the market its five-pronged approach to build a net zero aligned portfolio, including reduction of portfolio exposure to highest carbon emitters, to how you prioritize capital allocation, to even how you engage with companies. And, having been a member of your team, and, are always kind of our fundamental belief was, how do we protect and enhance return for our, own clients and investors? And how do you balance that kind of fundamental fiduciary duty to protect the economic interests of clients with helping companies, overseeing portfolio companies prepare for the net zero transition. Just wanted to kind of get a detailed sense of that from you.
Absolutely, and thank you, Lyndon. As you mentioned, we have quite a lot of information on the BlackRock website about how we're thinking about the energy transition and our role as an asset manager in that shift of capital that we anticipate over the coming years. BlackRock CEO Larry Fink wrote to the CEOs of the companies that we invest in 2020, saying that in our analysis, there's going to be a fundamental reshaping of finance as climate risk becomes better priced in the capital asset markets. So we have been working with clients to ensure that we understand their expectations of us as an asset manager on their behalf, and how we can work within our clients' mandates to offer them choice so that they can position their portfolios to be aligned with this significant transition that we're anticipating in the market. So in 2020, Larry said that BlackRock sees climate risk as investment risk. And as many of you on the call will appreciate, one of the roles of capital markets is to price risk and to bring future risk forward. And we believe that that will happen at a pretty accelerating rate once we have an enhanced understanding of the implications of the energy transition. At BlackRock, there are three ways that we integrate climate risk and all sustainability risk into what we do for clients. So on the active investment side, whether it's active equity or active credit, we're looking at data produced by companies and by the data aggregators like MSCI and Sustainalytics, and integrating that into our analysis of companies, either equity or credit securities, to understand from our perspective as a long-term investor on behalf of our clients what their risk and opportunity set looks like, and taking that into consideration in those buy and sell decisions. Many of you may be aware that the significant portion of equity investments that BlackRock makes on behalf of our clients are in index strategies. So our clients, by definition, are long-term locked-in investors. And in index strategies, we're offering clients choice to invest in index products that are linked to indices that take sustainability and climate risk into consideration. Some of those might be tilted to new technologies. Some of them might be tilted to best in class. It depends on the scope of the mandate. So through the index side, it's predominantly in product. But there's a third very important part of this that overlays both active and index investing, which is investment stewardship, which is the team that I'm part of. And through our dialogue with companies and through our voting at shareholder meetings, we are setting out our expectations of companies in terms of aligning their business model, setting out a business plan that ensures that they have a viable business as the global economy transitions to being low carbon, and explaining to investors the type of research and development they're doing, the adaptation they're doing in their production processes and so on, to ensure that they are keeping step with the change. And this is totally aligned with our fiduciary duty to our clients, to come back to the second part of your question, Lyndon, because we anticipate that there will be significant economic implications, both positive and negative. And we believe that companies that move earlier and take the hard decisions sooner are going to be less disrupted by the transition than those that delay.
Mm-hmm. Michelle, thank you. And, I guess natural follow-up to that question is, obviously on the proxy voting side, and, BlackRock has put out meaningful disclosure on how it's supported a lot of these, environmental and climate-related shareholder proposals, for one, as well as holding directors accountable, which is really nothing new in terms of BlackRock's practice. Now, kind of coming back to sort of fiduciary duty to protect clients' interests, when you kind of assess, let's say, the focus on E&P companies, for example, and if you kind of look at the returns profile, over the next 5 to 10 years, and if they radically shift their investments to kind of low emission based carbon tech, their returns profile by, probably for most companies becomes a little bit more uncertain than their trajectory. How do you reconcile that kind of difference between what you know for sure, like bird in hand, versus, that kind of pivoting?
Well, I think at some stage, all companies pivot their businesses. It's not unique to oil and gas. They just happen to be the focus at present. And we strongly believe that the energy sector is a key part of that transition. And they have engineering capabilities and geological capabilities and so on that can really bring the solutions to market over time. But it's really, again, asking management to set out their long-term strategy and how they see that pivoting and what the costs and benefits of doing so are. But that's a business judgment for management to take and to explain to investors. But it's not unique for companies to have to pivot as the world around them changes. And we see that driven in part by demographics. We've seen it driven by technology, the difference in retail stores now that a lot of retail business moves online. There's always change in the global economy, and this is coming back to this point of we expect companies to be nimble and demonstrate that they're taking advantage of the opportunities in that change and minimizing the risks or the costs to their business.
Yeah, thank you. And I think final kind of follow up on that before I kind of ask Ben a similar question, as he's an investor in the sector, is obviously on the ESG shareholder proposal, and you made very clear, and BlackRock's communications have made it pretty much beyond doubt that, the climate risk is absolutely a business risk. And aside from that heightened business materiality risk of ESG climate related risks, what other considerations go into play when you're thinking about, climate related shareholder proposals and such?
Well, I think we have to keep shareholder proposals in perspective. Fewer than 1% of the proposals that we vote on every year are submitted by shareholders. The vast majority are management proposals, and we vote on many, many, many more director elections than we do on shareholder proposals. So I think it's important to keep them in context. And even within the universe of shareholder proposals, the climate-related ones, which can be defined in different ways by different parties, are relatively few. So actually, the most important analysis that we do is in relation to the company's disclosures and whether the company's actions underlying those disclosures seem to be consistent with the risk and opportunity to the company in this energy transition. Where we think a company falls short, that's when we might vote in support of a shareholder proposal if it really is on point to the issue that we're concerned about, or we may vote against a director to signal that concern. Because in our assessment, directors have, as part of their responsibility, representing and protecting the interests of shareholders. And if we believe that they're not doing that adequately, then we may signal that concern or that sentiment by voting against their re-election. And we do look very closely at boards and the board composition of at companies where they clearly are going to have a really significant transition to make in their business, because we think it may involve or require a different skill set and set of experiences than many directors right now may have.
Mm-hmm. Yeah, thank you. Ben, I'm kind of curious about your views. I mean, Kimmeridge is obviously, a market participant, but as well, an important investor. And if you can kind of share with us, for those who may not be yet familiar with Kimmeridge's approach, for example, your kind of white papers have sort of signaled that E&P industry as a whole needs to really focus on kind of returns, kind of more value-based in terms of growth-based in terms of production. And now you've laid out some meaningful milestones in terms of, how the industry can pivot and really transition to net zero and how that can be possible. Before getting into that kind of details about, the kind of issues at hand, I'm just curious as an investor, I mean, what's the cost of doing business from kind of net zero perspective as an investor, right? Meaning, I mean, what is the cost of capital that investors like you are willing to accept, as well as the level of returns? And, if you can kind of understand kind of from how from a commercial perspective, you're thinking about net zero before diving into what Kimmeridge is, kind of proposing in terms of helping the industry pivot to net zero, that would be very insightful.
Sure, I appreciate that. I mean, I think, and if you step back, the first thing, and Michelle brought it up, is as we move forward over the next 10, 20 years, essentially what the market's doing is saying there's a price on carbon. And we can debate whether that's because of a lack of capital going into the sectors that are big emitters, or because we'll physically have a cap and trade carbon tax, or as we've seen in Europe. But ultimately what the market's saying is there's a price for emissions. If you go back 10 years, there was no price for emissions, and hence coal companies could emit freely, and then the cost of capital went up on coal. Gas came in, gas was a higher quality product, and essentially priced coal out of the market. So I think for investors, the thing to think about is in the next 20 years, we're going to see our carbon become an asset class. And much like I'm paid to produce oil and gas, you're going to be paid to remove carbon. And you're either going to be paid to remove carbon through technology and innovation, or you're going to be paid to capture it. But ultimately, there is going to be a price on that asset class. The other thing I'd agree with that Michelle said is, listen, there's a transition, there's change, there's always change. And with significant change and rapid change becomes a number of opportunities. And I think we look at the space and think there's significant opportunities across the space, both in the upstream oil and gas space and also in the carbon removal space, whether it be sequestration, changes in the electric grid, dealing with dispatch capacity, energy storage. I mean, it's one of the most interesting times to be an investor in the space because there's numerous different paths you can go down. The one thing I will point out is the IEA report is interesting, but we have a fundamental problem, which is what consumers want, which is the current on-demand electricity consumption patterns with no carbon footprint at a low cost, and what we can deliver are fundamentally far apart right now. And the transition to a low carbon economy is not a low cost economy, right? And we're starting to see this in California, we're seeing it in Germany, seeing it in the UK right now, which is one of the biggest challenges that we have is dispatch capacity. So the consumer ultimately has to understand its footprint and has to understand that it has to reduce its footprint. And that's been something we've been very shy about, whether it's avoiding cap and trade, whether it's avoiding carbon taxes. So, to give you an example of that, we've seen SUV sales grow more rapidly than EV sales. And then we wonder why our carbon footprint hasn't gone down in transportation. And this is fundamentally something that needs to be addressed. So from my perspective, I think it's a very interesting time to be in the space. I think there's a lot of investment opportunities. And I think one of the biggest thematics investors need to think about is that carbon will become an asset class. You will be paid to remove carbon. And when you look at the carbon cost curve, it's extremely steep. And what I mean by that is there's a lot of easy to remove sources of carbon, which are just, for example, replacing coal-fired power generation with natural gas. And there's a lot of hard to remove sources of carbon, such as flights. We all like to fly and we all like to travel, right? And those are very hard to remove sources of carbon.
Mm-hmm. Ben, in one of your white papers, you just set out specific goals and principles, right, that energy companies can adopt for Kimmeridge to invest in, including, eliminating routine flaring, reducing methane intensity, and reducing upstream, greenhouse gas intensity. Also, like BlackRock and other institutional investors, you kind of specify, that, each E&P company must align with SASB and adopt all 11 of TCFD recommendations. But you just spoke about kind of, the fundamental problem being on the kind of demand side. Consumer behavior, needs to really change, is not changing. So in terms of your recommendations, what's really missing is kind of scope 3. How can we think about scope 3 and how you think about how you formulate, your thoughts on scope 3, especially for this sector?
Yeah, look, my view is every E&P should be net zero on scope 1 and scope 2 immediately. That's something we as a firm do, and that's a combination of reducing your footprint and buying or investing in offsets. And we can debate the different mechanisms of offsets, whether you can buy them, whether you have to own them in-house, make those investments yourselves. I believe every industry over the next 10 years is going to be required to be net zero on scope 1 and scope 2 in the industrial base. And I actually don't think that's a particularly challenging ask. And that'll force companies to put a price on carbon. It'll force companies to reduce their own emissions, and then it will force companies to offset their residual stub of emissions. And I say this with personal experience with what we're doing in Civitas, which is the combination of Extraction and Bonanza. We've put a price on carbon, we're buying those offsets, and it incentivizes you to think about how you remove your footprint, in the business. And it really does focus attention. Scope 3 to me is very difficult, which is, I'm not sure as an E&P, I actually have a mechanism to stop anyone consuming my product aside from stop being in business. I'm not sure I can stop someone driving a car. So I'm fundamentally against scope 3 as a metric. I think if everyone reduces their scope 1 and 2 to 0, then we get to 0. But saying to, and I'm going to take a other company example, that Shell is responsible for removing their scope 3. Well, aside from taking Shell's existing business and becoming a renewable business, I don't know how they can actually do that. So you're really defining a complete change in their business strategy. I would rather see the upstream go to net zero, the midstream go to net zero, the refiners go to net zero, and the consumer go to net zero. There is no reason we shouldn't have an incremental carbon price at the pump, and the consumer needs to understand their footprint of what they're consuming. Otherwise, you get in this scenario where the consumer sits in their Escalade idling their car saying, I don't like oil and gas. And there's no connectivity between the two. And without the connectivity, the consumer understanding their footprint will never solve the problem.
I mean, that's kind of a brain teaser, I think, here, right? I mean, in your paper too, you point out that up to 80% of emissions happen at the combustion level, for kind of, from well to tank, that's about up to 20%, right? So, I guess, I can open this question up to like Water Group, Michelle, Sebastian, Kara, feel free to jump in. For upstream companies, for example, that don't have downstream assets, right? How can they think of, is there a way to impact kind of end use emissions? And, if you have Sebastian also, because, you have sort of your issuer clients that you're, perhaps advising on this issue, I'm curious about kind of how you think about this issue and what you're hearing from companies.
Sure. Well, let me actually kind of comment. I had an interesting discussion the past few weeks with a large ESG-oriented investor around what might SEC rulemaking mean around scope 1, scope 2, scope 3, sort of the whole sort of set of potential emissions. And what surprised me was the investor outlined a principle to me of do no harm. I said, okay, well, I think I know, say more. They said, well, we need to protect investors and potentially others against the danger that certain disclosures are designed or have the impact to simply drive divestment, right? That are simply used to let me exit from my portfolio certain positions and lead to, what they said was the privatization of the fossil fuel industry, right? Sort of this notion of what is the goal? If the goal is globally driving reduced emissions, well, if you take a certain sector that is, providing emissions that are essentially consumed by others and move it out of a set of folks that are held accountable by major investors, could that undermine some, other, sort of what the broader goal is? And for an investor to be raising that, I just thought it was particularly fascinating. When it comes to individual companies, it does seem, the notion of reducing carbon intensity seems to be widely embraced. You even see major investors who are creating funds that are reducing carbon intensity, but still include carbon emitters. But I think for at least some companies, and we'll talk, I'm sure, about different sectors and I know there's a number of people on the call who are not in oil and gas who should address too. But the idea of your operations and your products being efficient, right? Be the kind of, supplier or provider of choice, even if you are providing products that have, what then may become Scope 3 emissions, is when you think of kind of an overall industry type of pivots, it's likely that rather than simply a complete divestment, just exit entirely sort of relevant operation.
Mm-hmm. Kara, I think, just to pivot a little bit, right? Obviously Goldman Sachs as an issuer, you put out a meaningful statement on kind of both focusing on, net zero as well as creating kind of more of an inclusive community, from, providing financing to creating, instruments and products that help move client capital into a world that's transitioning to a low carbon economy. You must, as a firm, you also have to balance this, rapidly shifting net zero momentum with risk factors and potential unintended consequences. In terms of, how you kind of look at this world. And obviously, we also note that, we're talking about divestiture as kind of one of the topics, when it comes to energy. And, as there are some, more vocal kind of activists in the industry saying, you must stop the flow or promotion of capital into some of these E&P companies, right? So you see kind of on both ends, from both kind of advisory perspective and financing, this kind of conversation play out. Curious how you balance those two extreme opposites, and, more interested really on, how is Goldman Sachs, working on some of the practical solutions for your clients to, really help them transition to low carbon economy.
Thanks, Lyndon. So it's a great question, and a couple of points I want to circle back to that I think are really important that Michelle, Ben, and Sebastian all raised so far. Maybe I'll just start with from what we've discussed so far. I think what the good news is, we have clarity on, I think, the what that we're all trying to tackle within industry and within our organizations and sectors. And we have some clarity on the when, but I think what the challenge, where the real complexity is of course around how we're going to get there, right? For all the points that are been raised on, consumption and demand and the practical realities of what, the delta between some of the decarbonization trajectories and the scientific scenarios and where we stand today and what seems to be feasible. We do not have an explicit carbon price right now, to the points Ben's raising. You could debate whether there's implicit pricing being created, and I think Michelle's points around engagement, and we have a pioneer in Michelle who's done this for a very long time, not just on the climate side, I think could not be more spot on in terms of what's ultimately needed. And maybe a couple of data points just to take a step back on role of sort of FI, financial institutions in particular, just given where I sit and where we sit within the world. We were part of research alongside the Global Financial Markets Association a couple months ago that effectively looked at the makeup of decarbonization requirements on a sectoral, geographic, and capital investment required. And about 75% of GHG emissions that, given where we sit today, come from about 10 sectors, right? It's sort of the obvious ones that we're talking about. Ben knows them very well. Michelle spends a lot of time with them, as does Sebastian, right? Those are the key industries where we should be playing an active role in transition. Without that, there will not be progress in the real economy on emissions. The amount of capital associated with decarbonizing those 10 sectors by 2050 is anywhere from 100 to 150 trillion in capital. Sort of jaw-dropping estimates, right? But that's going to include investment and things like carbon sequestration. It's going to include, CapEx, asset purchase. It's going to require a lot of different mechanisms. We all have, eyes on the prize in terms of the when that we're hopeful for, but I think all the points that are being raised indicate that there are some practical realities that I think need to be sorted out in terms of consumption and policy, and frankly, also some social considerations, if you will, when you start to look at emerging markets and energy access and things like that, right, as well, which I'm sure we'll get to as part of this conversation. So I think what those points sort of tell you is that for us as an organization, divestment is not the approach. It doesn't mean that there's a role for policy in the similar way that there is, for Michelle in terms of their stewardship guidelines and voting practices. That does not mean that there aren't tough conversations that we have when we implement those policies, but it means that this is, for us actually to have impact in the real economy, where it's really going to come from, it's going to be capital provision, and it's going to come from strategic advice. And so when we came to market at the end of 2019, and David Solomon was very intentional in how he put out this commitment, which was a $750 billion commitment to finance, invest, and advise by 2030. That was different than what we had seen in the past, in particular because it is so cross-cutting, across our business. So it was a view that this is, first of all, it's not just about climate, it's also about figuring out how we can do this in a way that improves access, improves affordability, and improves quality of service. So it was not just a climate focus, but it's sort of two sides to the same coin, but also that this is about figuring out where we can advance capabilities so that our asset owner, asset manager clients have an ability to look at their portfolios or to have the tools that they need to evaluate progress. But we can also leverage those insights and share them with corporates and share, frankly, with asset managers and asset owners some of the challenges when we spend time with corporates that Ben is raising of why it isn't, maybe they won't see that progress. Maybe it doesn't make sense for them to look at Scope 3 today. So I think there is sort of that intersectionality, collaborative role that we have the ability to play as an organization that doesn't always show up in the dollar commitment when you have the 750 and you show the breakdown of where you're allocating capital. I think there's some nuance there that's happening behind the scenes that's occurring in, Michelle's engagement work, for example, and Sebastian's work and Ben's work that is actually really important on the how, that may not be as obvious and apparent to the external world, but I think is huge. And without that, we frankly won't really make progress. If this becomes simply a carbon accounting exercise, like we will not actually, we're not actually going to make the substantive progress that we need. The second thing I'll just say in terms of the framework and the role that we hope we aspire to play in transition, I mentioned not just about climate, but also about inclusive growth. And I mentioned cross-divisional. One of the big questions that we really tackled as we were looking to operationalize this commitment was, how do you do this at scale? And I remember one of the members of our executive team, when we sat down and talked about this was kind of the key question. He said, this is, how are you going to be in a place where in 5 months, 6 months time, you actually can have deep conversations, provide expertise? How do you scale this within our organization so that we can be front and center and we can really move the needle with our clients? And it could not have been, a more prescient sort of remark, because what we ultimately had to do, and we did, I think in year one, 1,000 meetings. A lot of those meetings were with, CIOs and CFOs and CEOs and board members. And it really was around taking each division and working closely with senior leadership. And we ended up launching these councils. We launched Sustainable Solutions Councils. It could not have been a better opportunity for individuals who were spending time with metals and mining clients, who were spending time with asset managers who were banging their heads because they didn't have the right climate data to actually footprint their portfolio, to actually have those use cases and have those individuals who are on the ground put their heads together and figure out what the right solutions were, and then figure out how we can connect the dots. And the last thing I'll just say is, we have an interesting experience as an institution, and I think probably the same, similarly for Michelle, where we actually need to think about the impact of physical risk on our business. We need to think about the impact of transition risk on our business. So we actually need to, our own real estate portfolio, we need to figure out what weather patterns and what potential policy risk could mean. And those insights and that sort of process and discovery, if you will, thinking about then after you run that analysis, how to integrate it into your risk management processes. I think that experience that we're going through as an institution is really beneficial for the insights that we can share and discuss and bubble up with clients as well.
Thanks, Carol. I think the theme that just pops out there is kind of the role of collaboration you just mentioned, in many, especially, when it comes to, the energy industry. I mean, not everyone is kind of, the energy expert, kind of sector expert, like, Ben and the team at the Cambridge. From, just before we kind of hop to, Ben for his input, on kind of what kind of role that he sees, collaboration, with other sectors and, other investors kind of playing into kind of the E&P sector. But curious from, both Michelle and Kara, so for example, in terms of, climate data, how you measure, report, when everything's still pretty fragmented, a lot of, investors, even PMs are, pretty much generalists, in many of these firms. How do you kind of marshal your resources, and how do you work together to kind of, at least come to some kind of a consensus? Let's say something as simple as, well, I say simple, climate data disclosure, right? Like, how do you collaborate, and what kinds of initiatives are underway right now that we should be aware of, so that our issuer audience members can also kind of take note of this?
Sure. I mean, I'm happy to start. I think that is really the question that many of us are grappling of, sort of, we have, line of sight of what we can do within arm's reach in our organization and continue to put this at the forefront of our business and strategy. But then there is this broader question. You sort of know that is not going to be enough in and of itself. That's not sufficient. And so what else can we do to put our heads together and bring together complementary expertise to tackle some of these challenges? I think you're right that one of the big knotty ones is certainly around data and disclosure. I want to be careful in sort of how I describe it, because I think I know, Lyndon, you didn't want to have an hour debate on SEC's proposal around climate disclosure, so I'll make sure we don't veer that way too much. But look, to be really direct, I mean, I think we have a third of public companies today disclosing scope 1 and scope 2, and we could debate then the value of scope 3, but for certain sectors, scope 3 certainly is a substantial majority of emissions, and even scope 1 and scope 2. There is, for a lot of industries, there's a high level of estimation when you start to going back to the climate risk management points that a lot of us are grappling with. So I think it is clear that data is the lifeblood of markets. We know that. In finance, this is the exact same situation we're in with climate, where we need to be in a place now where we're not just making commitments, but where we're evaluating progress. But the question is, what is the data that you really need to effectively do that? And some, emissions is important, but that's not the only thing that you need. And one of the organizations that I think is doing great work in this area is called Open Source Climate. And it's part of the Lennox Foundation. And part of what this organization is really looking to do is to acknowledge that there is sort of a fragmentation of data points that are out there. We don't all need to agree on, the complete distinct universe of data that is needed, but there is some value in having, sort of information portals out there where we actually can have the data points that are needed to measure progress. And a lot of this is out there, frankly, it's just in different places. So it could be publicly available generation data or fleet data or climate scenarios, but actually having the ability to put it in one place that's easily accessible for all market participants is part of what they're doing. And then the second is figuring out how tools can be built collaboratively so that, again, we don't need to all measure progress the exact same way, but is there some commonality in methodologies and tools that will actually, that where there's value to not creating those, and frankly, putting in the dollar and investment required to do that on a bespoke individual basis at every single firm. And I think on the climate disclosure side, this is one thing that Lyndon, you and I have talked about a lot of with all of these, how do we ensure that this is actually moving the needle and it's not very high compliance costs, right? So I think on all these things, that's the question we should be asking ourselves is this going to move the needle? Or, is this kind of not information that we need for this particular sector or just point in time? Are we just not there yet? This isn't the type of information we need right now. We may need it in 5 years. So that I think is one area is on climate data. I think innovation is another area, and in particular, I want to point to the role that I think kind of nonprofit and public sector can play here, which is huge. There are a lot of, I mentioned, a few minutes ago, just sort of inclusive growth and climate being two sides of the same coin. There are a lot of, I think, important considerations that yes, role for policy to take on, but I think there's also opportunities for us to leverage insights of, nonprofit and, multilateral institutions who are doing a lot of work in these different markets to figure out how we could potentially come up with new innovative approaches. And one thing that we had the opportunity to work on earlier this year with Apple and Conservation International was a $200 million commitment to accelerate nature-based solutions. So effectively, what is a traditional process of buying offsets, instead trying to figure out how can we actually invest directly in the forestry projects, create then a financial return for investors versus what is typically an expense. And actually, do that in a scalable way. And so that was and Conservation International was hugely important partner in that. So just on this public-private collaboration point, and I think that's just one example of many, many that you see in the market today. I think the more that we are open and have the ability to do that, I think the more we're going to be able to accomplish.
But Lyndon, can I make a comment regarding that? I mean,
Please.
I agree on some of these things, but to me, the SEC, or from an accounting standpoint, all companies should be required to report Scope 1 and Scope 2. And I think you're going to see over the next 10 years that become an SEC requirement. And if I think about the business, there's a business in monitoring, reporting, auditing, reducing, and offsetting. Right, that's how I think about the scope of what you've got to get involved in. I agree. I mean, if I look at forestation or afforestation, I think that makes sense too. But the reason we're talking about these, and to actually get involved in those businesses, you have to understand the supply-demand dynamics of the market. Right, we know how much supply we're putting in of carbon, and we have a target for how much we want to reduce it. And you should let the market price it. But we have to have transparency in terms of reporting and who's generating it to let the market make those decisions. And I think if you do that, ultimately what you'll see is a carbon market evolve both on a US basis and a global basis that probably trades in the $75 to $100 a ton, in which case afforestation makes a lot of sense, both economically. I don't think you actually need non-government organizations to get involved. I look at that and say, there's a really big opportunity in that space because it's a scalable, low-cost way of removing carbon that we should incentivize people to do. And then the individuals involved, whether it's corporates or consumers, understand their carbon footprint. There's a price on the product and will be incentivized to remove it. And look, if we set the target as zero carbon under the IEA model, then carbon prices may trade to $300 a ton and direct air capture may become economic, right? But I think that the risk we run, personally, that I see, is that governments are making arbitrary decisions on where to direct capital to resolve the problem. And what I mean by that is, investing in hydrogen. It may or may not work, but it may not be economic relative to taking a coal-fired power generation and putting carbon sequestration on the back end of it. That may be a better, more cost-effective solution. And if we make the wrong decisions and we invest in expensive technologies that are not the cheapest way of solving the problem, we're just going to end up in driving up energy prices for the consumer. And we see that in California. We're seeing it in Germany. And ultimately, that's a regressive tax on the people that can least afford to pay it. And I think that's one of the risks we have to understand here, which is, I think you're better off letting the market solve it. But to solve it, to Kara's point, you have to report it first and actually understand where those emissions are coming from.
Mm-hmm. Yeah, Ben, I guess follow-up question, I think it's pretty meaningful pivot is, we have to go back to the boardroom, right? And you just mentioned, that you have to let the market kind of solve these problems, and, through private ordering somewhat. Kimmeridge, has had a number of, papers critical of kind of by and large, the sector over the past decade, kind of focusing more on, growth rather than returns, right? Sometimes investing more than 100% of cash positions into growth. And, in terms of, when you're reading the market, when, the energy companies have been, pretty marginalized and kind of getting shut out of S&P 500, for example, being excluded, would it be fair to say that kind of over the past decade, sort of the E&P sector itself has been, in terms of, how can I put it, in terms of kind of board oversight of the business, focusing too much on growth rather than returns and value-focused production? How do you think, markets should understand this sector now? I mean, you yourself, Kimmeridge has, committed to reduce emissions by 50% by 2030, and you're encouraging the sector to do the same. Like for kind of energy companies in the audience, and especially for the board members, it's, how should they kind of position the conversation with investors like BlackRock and others, and really collaborate with them to, kind of, steer towards this moment of transition?
There's a lot of questions in that question. Look, I think if you look at what we're doing in Civitas, right, we've committed the company to be net zero today. And, as I said, there's two components of that: how much you're reducing your emissions and then offsetting your remaining stuff. I think the oil and gas industry for the last decade has had a terrible track record. I mean, in terms of just being profitable, which has made divesting oil and gas even easier, right? And now, what'll be interesting is the sector started to adopt a new business model that's more profitable with better free cash flow yields. And now it's trying to attract investors back into that space. And that's going to be hard with the ESG overhang. The interesting thing to me, though, and I think it's a really question for Michelle and Kara, is what you'd like to see is E&Ps that adopt better business models, whether it's net zero, attract capital and trade at a premium to those that don't. We haven't really seen that yet. And I actually had this conversation with the governor of Colorado. I said, well, if you're successful and you adopt a new business model and you're best in class, you would hope that capital would flow towards you, that you trade at a premium, and you can consolidate other players in the sector and therefore enforce a better business model on the rest of the industry. And the reason I brought it up is it's in direct contrast to the divest model. And I don't think anyone on this call is making the divest model, but you see it amongst the majors. They divest assets, they go to a private operator who discloses nothing. It's a worse operator, emits the carbon, and it actually makes the situation worse. And I think what we've really, and it goes back to, you can do none of this unless you're actually reporting and disclosing your carbon footprint and everyone understands it. But you'd like to believe that the allocators of capital who are on the call here actually disproportionately allocate capital to these better operators, because what that'll allow them to do is then demonstrate why that business model is better and enforce it on other people. So, what I said to the board at Civitas is, look, carbon is an operating cost. That's why we're going to put a price on it. That's how we're going to think about it. That's why we'll want to reduce it, because it's better business for us. And if we do that and we attract investors into us, we should be able to trade at a premium but it's then going to give us a currency to go out and consolidate other people, and we can dictate that business model to other people. We haven't seen that yet, but I think that's one of the big steps you're hoping to see amongst capital allocation and the carbon markets and upstream, so that we can actually, continue the evolution.
Michelle, your perspective here too, and Kara can jump in.
Yeah, I had a couple of points. I think one of the things we also have to bear in mind, to one of the points Ben made earlier about changing consumer demand, is that the vast majority, ballpark 80% of fossil fuel assets are owned by not public companies, whether it's states or private sector operators, but not public companies that BlackRock or other asset managers or asset owners are invested in. And so as much as investors can move capital and can send a pricing signal in that way, there's other change that has to happen in terms of public policy regulation and consumer demand to complete the picture, if you will. Capital markets can do their bit, but they can't do everything, is one way of putting that. To go back to the discussion about data, BlackRock uses a risk and investment management platform called Aladdin. We have a component of Aladdin that's called Aladdin Climate, which is drawing in available data from as many different sources as possible. I am not a data person in the sense of being able to look in the background to all of this, so I can't tell you much more than that. But this is a tool available to our investors, the capital allocators, and to clients of Aladdin. And as we get better tools and more people use tools and create a feedback loop of what is needed, I think we're going to make real progress there. For ourselves, we're doing a lot of research using the data we do have, partnering with other specialist entities through our sustainable investing team to look into what are the critical data points and how does that then inform where we allocate capital, so that the premium, if you will, that Ben's talking about starts to show through. And one thing that we think is going to become more of a focus for companies and for their auditors in the coming few years is how are a company's climate risk assumptions and climate opportunity assumptions, but let's look at risk for the moment, reflected in the financial statements that they're already required to produce under existing accounting law. Because there is a growing body of opinion that existing accounting standards require companies to reflect that if an issue or a risk is material to their business. And there are many companies that say in their 10K that climate risk, whether it's physical or regulatory or transition risk, is a material risk factor. How are they reflecting that in their assumptions relating to goodwill and asset impairment and so on? And I think that's going to be an area that will drive change in behavior within companies and potentially within company asset pricing in the near term. That may be a little bit of a sleeper for a lot of people right now.
Yeah, look, I think this is such an important point, and I would say it's completely consistent with the dialogues that we have with our corporate clients and institutional investor clients. I think on the corporate side, there absolutely is a sentiment that not all investors are created equal on this point, right? And we're talking about a couple different, I think, just to distinguish too, there's a climate risk question. How effectively are you managing climate risk? But then there's a sort of slightly different question, which is, so climate risk, how prepared are you for sort of the financial impact of climate? There's sort of a related but somewhat distinct question that we're talking about, and to Ben's point, which is, is there going to be a differentiation in capital allocation decisions based on how well I am positioned from an alignment perspective? So to meet sort of global climate goals. Mm-hmm. And, there are some clients that are more high profile that do get a lot of questions, but there are many clients in these sectors that play meaningful contributions that I think, do get different conflicting views from the institutional investor community of of what is really wanted and needed. And then I think the second point is there are very clear frameworks for how to think about investing in lower carbon solutions and clean energy, but to differentiate within a intensive sector, to Ben's point on who's really taking more of a leadership stance, like that ultimately that needs to happen for companies to feel that that it's being valued in the market. It's not just being valued in terms of an engagement conversation, or they didn't get a shareholder proposal. Like that distinction, I think, is what Ben's pointing to, which is critical.
Mhm.
On that, I think the reality is how investor bases of companies have changed. In recent years, over the past 10 years, which is interestingly during the same period when just the world's and the US's attention and Europe's attention and UK around climate and ESG issues is just fundamentally different, right? The posture and the perception. I think companies are often a bit caught in the middle of just a radically evolving investor stance on these topics. And when you think of differentiation, there's how does a company differentiate itself with folks who are actually determining the marginal trading price of stock, right? People buying and selling. But also, I think very importantly, how companies are differentiating themselves with those investors who are making stewardship decisions, making engagement decisions, making voting decisions. I think also when you think of the value chain at the investor level, the pressure that the asset managers are under of all kinds on these issues is tremendous. Open question whether how that pressure can get channeled into kind of productive, right, approaches rather than ones that sort of just evolve more into, well, were you for or against management or the board and that being a metric, rather than the much more sophisticated, nuanced, difficult assessments that are really required to assess what is a company's transition readiness, or what does it mean to be a leader. I'd also note that some decades ago, perhaps there was a perception that companies were sort of monolithically opposed to these types of issues. And let's not debate the extent of that truth. But where we are today is that companies, publicly traded companies, there are many across industries that are embracing taking a leadership role. Obviously, just this morning, we got the climate pledge, that Amazon and then Global Optimism that's founded by the former UN chief of climate. You just have more and more companies saying, we're going to accelerate, right, net zero to 2040. You've got people, Salesforce thinking about, well, how do we work with suppliers and even build into contractual constructs, climate, related commitments. But, and even within, yes, the energy sector, you have people who are choosing to be leaders. Now, it may mean being a leader around carbon intensity, scope 1, scope 2, support for smart public policy, rather than being a leader in, okay, we're just going to wind down our business, divest, and just conclude, operations. But I think these are sort of the type of leadership that warrant credit. I think also because investor bases have changed so much, how do you define companies getting credit and recognition for this? We'll never go back to where it was simply a matter of, okay, what's the stock price? Now, over the medium to long term, I think Ben makes a very powerful point that, well, shouldn't certain operators still be able to attract capital from investors, right? And I think, rather than a pure divestment type of construct in the publicly traded market. And on this piece of companies being caught in the middle here, look, to be able to have a serious conversation with investors of all types on these issues at the company level requires a meaningful level of sophistication on the part of the company. Sometimes that's training and education at the IR level. Yes, some management. On my view, whenever I speak to boards of directors, is these are issues that the board needs to be aware of. But it takes management structures and management leadership for any of this to actually make sense. And that's just going to continue. And the notion that you have, again, some companies saying, hey, we can lead on this. Other companies are saying, let's just understand this. Because my view is it's always very risky for a company to let themselves be in a position where third parties have better data and better understanding of where the company stands on any issue than the company's internal teams. And on this point of auditors, companies are going to get, it's not a problematic wake-up call, but going to get an interesting wake-up call when, coming with these coming quarters, auditors are pressing management to at least have a meaningful financial risk, climate-related conversation into financials. Okay, how does it, management consideration, management assessment of these issues, right? Physical risk. Does it affect the supply chain in any way? Okay, litigation, the regulatory environment. The truth is there's so many constituencies that a company ought to inspire the confidence of, but it's important that companies inspire the confidence of their own auditors, as well as inspiring the confidence of the board of directors, as well as, of course, investors, on these issues. And I think, as we all know, there's chicken and the egg, there's carrot and stick. There's also, viewing this from maybe a defensive posture or an area of risk as opposed to opportunity. But if a company isn't at least grappling with this as a matter of risk, right, they're just going to find themselves very far behind.
Yeah. So which brings me to my last question, which is sort of the board's role in this, right? So I guess Sebastian, let's start with you first, and we'd love to also get from Michelle kind of her recommendations on best practices, and also Ben from his perspective, given his kind of focus on the board's role here. I mean, from where you sit, Sebastian, I mean, how is net zero transition conversation really shaping the conversation in the boardroom? And obviously, given that institutional investors like BlackRock, they're usually correlating how they're thinking about ESG issues such as net zero to capital allocation discussions, corporate strategy, among others. I mean, what are you seeing out there? And, just quickly following up, Michelle, would love to kind of get your recommendations on best practices for the board members in the audience.
So first, I'd say it is, literally evolving in real time. And the challenge or the opportunity is, like, for a management team, are you ahead of where your board is? Or are you finding yourself behind where your board of directors is or wants to be, which is always a dangerous place. Look, as kind of investor and stakeholder scrutiny of ESG broadly accelerates, and obviously there's climate change, boards are facing heightened expectations on their oversight of these issues. Now, management of climate change related risks and opportunities generally does require a bit of a long-term strategic approach. But boards are going to have to work with management to oversee how do you integrate climate change related considerations into business strategy, into operations, yes, into capital allocation, into disclosure. How do you think about monitoring progress and performance over time? There's also for some companies just the practical element of, shouldn't we at least be prepared for the rulemaking that is about to come? Because the U.S. is obviously, U.S. regulators are pivoting to a stance of leadership and engagement on these issues rather than just leaving it to the private ordering type of standpoint. I think it also requires a bit of a sophisticated view, like when it comes to net zero. Look, for some companies, this just is very well aligned with business priorities, with customer observed preferences, with suppliers, with collaborations. It kind of becomes, once you understand the issues, a little bit more of a no-brainer, right? Or at least let's not be a laggard. Other industries, other companies, it's more complicated. You still need, need to attend to it. But I think boards are appreciating that whatever their initial point of view on this is, investors and other stakeholders are reframing corporate strategy issues, capital allocation, missteps, kind of disclosure, types of choices into governance questions. And perhaps sometimes unfairly, governance failures, sometimes viewed as, fairly rounded, but as a governance matter, how you are set up to engage on these issues, how are you set up to engage on them, not once every few years, but at least annually? And is it something that gets part of a strategic plan and at least a roadmap, right? Because this was the sustainability reports, there's version 1, 2, 3, 4, 5. On climate, there's going to be, kind of an evolution and move of it. And of course, the risk of activist attacks, in these issues is, only increasing. And companies are just going to you're either on the back foot or you're figuring out how do we get ahead of this? And if you disagree with your investors, which perhaps I shouldn't say with sort of this group, but that can happen. That might be okay. It might be a good thing in certain cases. But okay, if you disagree, recognize you now need to move to either investor education or engagement on how do we reach alignment on time horizons, on choices, on our priorities, and just move, please, to more of a dynamic of partnership and collaboration rather than only kind of zero sum confrontation.
Yeah. Michelle, what are your recommendations for especially non-EMP companies thinking about net zero? Obviously, a lot of companies are putting out kind of a longer term target on when they expect to be net zero, but you also think about meaningful interim steps. So what's your recommendation for the board to focus on and prioritize?
Our BlackRock's recommendation is that companies get the information together that would enable them to report to the recommendations of the Task Force on Climate-Related Financial Disclosures. And for those not familiar, the recommendations have 4 pillars, the first of which is governance. So what is the board's role in overseeing management in relation to climate risk? What is the board's role in holding management accountable if the board is concerned that management is not taking the appropriate steps given the risk to the business? How does the board ensure it understands enough about the company's climate risk to take those assessments? And so, TCFD, I think we've all mentioned it one way or another, is a foundational sort of framework for any company that has any form of climate risk, whether you are impacting the climate through your operations or being impacted by it, say through supply chain disruption. And then the key thing from BlackRock's perspective is that there's sufficient fluency on that climate risk and how the company management is addressing it, that if we were to seek an engagement with the relevant board members, that would be a productive conversation for the board members and a productive conversation for BlackRock as an investor. And it isn't about having a climate specialist within the board. It is about there being sufficient understanding around the table for the entire board to be engaging management on management's approach and being willing to act if they think management is behind the curve. And as I said earlier, we think that companies that don't act soon and start taking reasonable measures are going to be seriously disrupted. And to the point that Sebastian made, most shareholders will look to the board to hold the board members accountable if there's a governance failure in this area.
Yeah.
And
maybe, curious. Yeah.
And I was just going to add, maybe just one follow-up. I do think the clarity with which, Michelle and Sebastian are sort of pointing to best practices of, it doesn't have to be a fancy glossy report, but to have those sort of framework pillars out there is very useful. And it's going to, I guess, help you to orient within the organization so that you are, being efficient with the resources that you have and putting it in the right pockets. Because this really is a question we get a lot, which is, it is such a complex framework to navigate between different ratings and, different ways that your progress is being measured. And how can I possibly, resource this in the right way? And so I think just, it's not a one-size-fits-all model, but that's it's such a helpful framework, I think, and all the hard work that was done around the Sustainable Accounting Standards Board over the years, which was really I feel like the first time we started talking about that framework was like 10 years ago. I mean, there's been a lot of, corporate and institutional investor perspective that has gone into, I think, those two in particular over the course of many years. And so just to sort of double click and underscore that, that those are really useful starting points. And so I guess not be so overwhelmed by all the different asks, because it is very difficult to sort through what's actually meaningful and where should I be allocating the resources within my organization to do this in a best in class way that is going to be recognized externally.
Yeah. Dan, your thoughts on board accountability here?
Well, I just wanted to raise one point, which is why I've been such a strong advocate of this difference between scope 1 and 2 and scope 3. And it comes down to the role of the board. if you say to me as a board member of an E&P, I have to take my scope 3 down, you're asking me to liquidate the business, essentially, or materially change the business. And as a fiduciary on the board, that may not actually be in the best interest of shareholders, which is why it puts a board member in a very difficult position. The other issue is you have very little control over doing that. So you open up, I believe, a path to litigation where someone, and we've seen this with some of the European majors, where you make scope 3 commitments, and then you're asked, how do you actually implement these? And you don't have a reasonable path to implementation that you can stand behind, which is why I think, I've been very hard on the line between scope 1 and scope 2, something the board can control, something the board can deliver and they can implement, versus scope 3. And I think we have to give some thought to that about if we set unrealistic expectations to boards, they do have a duty to shareholders, and they can't just commit to a scope 3 reduction when you actually have no way of actually enforcing it. Otherwise, look, I think all of these boards should be having these conversations. And I think every board should be sitting there saying, how do I get my scope 1, scope 2 to net zero? It's a path we're going to go down. And the sooner they have the conversations, the further ahead of them, the more value they're going to create. I mean, I've said this in the energy space and, both for my business on the private equity side and the E&P space, I believe it's a competitive advantage to be ahead of this. And that you can differentiate yourself from the pack. You'll have a lower cost of capital, better access to permits, to operations, a license to operate. You can frame it however you want. But ultimately, boards should have their heads there, because those who get there first will outperform those who don't.
Yeah, thank you. We're going to pivot to Q&A mixed with some lightning rounds on kind of topics we didn't cover. First question is for Michelle and Kara. Are you evaluating companies' low carbon transition plans at this point? And if so, what are the key elements in that plan that you look for?
We haven't started evaluating the plans as such. A lot of companies are yet to even really publish detailed plans, but we are having conversations about the work that's gone behind or gone into setting out the plan, the work that's gone into setting greenhouse gas emissions reductions targets, and so on, because we want to see that this is really embedded into the way the company is being operated, and that there really is a commitment to making some pretty material changes in some companies' cases. And so it's really a little early stage for evaluating plans. And I think we as investors also need to build tools and toolkits, if you will, to be doing that. And I think the Science Based Targets Initiative is one of those tools that is rapidly developing, but there are many other industry initiatives that I think will help with that evaluation in time.
And I also think, paired with the evaluation is the implementation side. It's actually figuring out how can we help facilitate that with portfolio alignment analytics, or for some of our corporate clients, what are some of the tools that they actually want to be able to evaluate and see, so that they understand, where their movements may or may not, how those movements may or may not be received from the investor community. Evaluating different financing capabilities like KPI linked financings, which, we've all followed the green and social sustainability bond market. But so I think the evaluation is important, but it's also figuring out ways that we can partner with them on implementation.
One lightning round question. Say on climate, yay or nay, and is it coming soon? Michelle?
I would say, like many shareholder proposals, it's an option and it may be a relevant proposal to vote on, but our preference is to vote on directors who have a responsibility to shareholders to lead with management to ensure the business has a long-term future.
Sebastian, any thoughts on Say on Climate?
I think Say on Climate is already here, and it's just as Michelle said, it's a Say on directive. I think, though, I'd love to see a world working on creating where investors can give companies more advance notice more of a heads up. How should this Say on Climate, manifest? Because there's a bit of a, and I think to the earlier question of, is there a scorecard? How do you evaluate a low carbon transition plan? It's interesting. I mean, we found there's some particular kind of elements that we find some investors focus on more than others, but there's inevitably a quantitative piece and a qualitative piece. So there's so many judgments that are needed, just as Bennett highlighted. Business judgments are called for, right, around it. So I think it's here. I think the concept of a standalone shareholder proposal or a management proposal, you're going to continue to see an increase, on those. It's going to happen globally. But the big jump will be Say on Climate at the director level.
Thank you. Ben, I have a question for you. Do you see the oil and gas sector's investment in biofuels and feedstocks as a viable abatement strategy? And I guess lumping into that, how would companies think about, sort of, how do they justify premium to renewables as, essentially justified in terms of investments? Broad question, but.
Yeah, I mean, look, I think all abatement strategies are worth exploring for upstream E&Ps and integrated oils. Look, I think when you look at the carbon world, it's all of the above, right? Whether it's transition, renewables, forestry, abatement, all of those different categories. I think, the challenge, I think, on renewables and large-scale renewables, and BP will be a test case of this, is there's a time and a place to make the transition, and you've got to avoid the risk of moving into a sector at a premium multiple with limited returns, right? And one of the challenges I see, and it's just a personal opinion, is that large-scale renewables is actually a low-return business with a pretty flat cost curve. And that's going to be a challenge, which is, and at the moment, those businesses trade at a premium. So, taking capital when you're trading at a wide valuation spread and moving it into low returning assets is not necessarily a viable business strategy. And you can go back through the history of multiple different industries and look how people have made the transition at the wrong point of time. I mean, you only have to think about AOL and Time Warner, Altria and Juul to recognize mistakes like that. So, look, I think you got to be careful about when and how you make the transition. And in many cases, it makes more sense to do it organically than inorganically.
Yeah. Final question, and that is, pretty important one. Companies are pressured to disclose carbon reduction and net zero targets. How can we, I'm assuming investors, hold management accountable for targets, yet not deter them from setting higher goals? Kind of nuanced there, right? I guess it's kind of like, how do you sort of get their sights set higher than sort of the median or the average?
I think everyone on this call, and maybe I shouldn't speak for everyone, understands this practical reality in terms of what you can do, right? And I hate to say it, but there's an evangelical wing that says we want to get rid of everything today. And the reality is it's just not practical to do that. And I think that's the same thing as you can set standards for boards, but if you punish people for getting I mean, the upstream business is an ideal example. You want them to disclose what their carbon footprint, but you don't want to vilify them for having done that. So you have to find the right balance in encouraging people to show their carbon footprint, and then applauding them for reducing it, even if you don't necessarily like the starting point. And that's a difficult balance to strike. I'm not saying I know the answer to that, but I think that's a challenge we're going to continue to face.
But I would build on that by saying, I don't think anyone's expecting somebody to make targets that are set in stone. I think it's reasonable to set targets that you believe are achievable but still stretching, on the understanding that as technologies evolve, as innovation leads to different ways of developing product and so on, you can extend your targets or build more stretching targets. But to do pie in the sky targets isn't in anybody's interest, because it doesn't help investors understand what's going to happen in your business to affect change. And it does open companies potentially to all sorts of reputational risks.
Great.
Yeah, and
Thank you.
look, I mean, all of these, science-based scenarios are going to have policy assumptions. They're going to have consumption assumptions. So I think, to Ben and Michelle's points, those are going to evolve over time. And so those are important practical things that need to evolve and change. And so I think there's a bunch of different inputs, technology advancement, there's a bunch of different inputs that are going to evolve. So it is not practical, I think, for this to be an area where any aspirational commitments are completely static. In 4 or 5 years' time, there should be inputs that have impacted the pathways and scenarios, and therefore the way you think about feasibility and or aspiration.
Sebastian, last word on this, and if you can kind of, shove in here kind of your kind of observations on what's happening on regulatory front, that'll be very useful for the audience.
Yeah, sure. Briefly, look, I think with respect to net zero, at a minimum, any company making a net zero type of ambition, target, goal, commitment, what have you, needs to be sure that they can really pass the good faith test, particularly with these assumptions and the like that are going to come over time, and knowing that these are multi-decade goals that of course require adjustment. But I think to Kara's point, the idea that there will be inputs, changes, adjustments, developments, shortfalls, maybe accelerate, maybe you need longer, you need to have some type of internal control and system where you will be regularly reassessing your progress towards the goal and taking into account all of these sort of potential variables, so you can figure out, do I need to update or not? Do I need to offset or not? And I think on that theme, look, we are going to be seeing, SEC mandated rulemaking around mandated climate-related disclosure we're expecting, and obviously other areas mandated more human capital. There's going to be stuff on cybersecurity. There's going to be some governance-related, broader set of topics. But on climate, we'll, scope 1 and scope 2 is being seriously evaluated. Scope 3 is being also sort of assessed as to where it's going to come. But also this notion of, if a company makes certain commitments forward-looking, it's possible that there will be some kind of rulemaking or interpretive guidance or the like that is about, well, can there be more transparency, right? So, and so you just have to be ready for that type of world where more transparency will be, will be required of you. And, kind of just baseline, whether or not you're using TCFD or other external standards, and we think the SEC may decide to just have their own type of requirements. There's one simple question that every company now has to be able to have an affirmative answer to, and then explain. Is your leadership managing climate-related risks and opportunities? The answer of, what do you mean, that doesn't exist, that's not in any way relevant, no longer flies in any capacity. And then it becomes, okay, how are you managing? And wherever the specific rulemakings come out, quantitative, qualitative, that type of concept, which implicates governance, as well as process, is the big picture that every public company needs to get to. And if they don't get there, their investors are going to essentially mandate it.
Yeah. On that happy note, I just wanted to apologize. I told you guys that I was going to keep a tight ship and close right at 1:45, and we're going to run over. But also blame you guys for, I don't exactly have shy friends here in this room. Thank you for your comments, and for the audience members, thank you so much for tuning in on this very important topic. And once again, thank you, panelists.
Thank you. Bye, everybody.
Thank you.